Welcome to Tech Domain, your guide to the tech sector. From the Mag 7 to AI and semiconductors, this is your hub for the tech titans driving the future. This is what you need to know.
Software stocks got a boost last week on positive earnings reports touting AI growth. While AI is currently a boon, could it also be a key risk to some of these companies? The Autodesk CEO saying on the company's earnings call, quote, AI may eat software, but it's not going to eat Autodesk. Joining me now is Steve Koenig, Macquarie head of U.S. technology research. Steve, it's good to see you. So this has been a little bit in tension and a little bit sort of debated over the past couple of years, the relationship between AI and software companies. How do you think about it, and which ones may do better in this kind of environment?
Great. Thanks so much for having me on the show. I think there's actually a ton of overlap now between AI and software. And one way to think about it is that virtually every private company that's getting VC funding nowadays has an AI angle. So interestingly enough, though, if you look at the top AI native companies that originated as being AI focused, and we've compiled a list of the 58 top AI disruptors, we call it. That list is entirely private companies. There really are no public software companies of significance that originated as AI companies. And as you noted, we're seeing increasing competition between those AI native companies and the public software companies. And in particular, the large SaaS companies are working very hard to try to protect their application domains from incursions from AI natives. And so you're seeing increasing competition there happen.
Steve, I just want to put a fine point on this because I think it's really interesting. So your distinction between AI native companies, those that began as AI companies, and those that have sort of bolted it on in various ways. What are some examples of when they are going sort of head-to-head here, those publicly traded software companies and the privately held AI companies? In other words, what exactly is being replaced? What are some examples of that?
Great. Yeah, thanks. That's a great question. And there are, the very largest AI native companies on our list are the model companies. So your OpenAI is responsible for, roughly almost half the valuation of the total list of private AI companies, and you've got Anthropic in there as well. And those companies, OpenAI is both a partner and somewhat at odds with Microsoft as well. And potentially there's more competition in the future. I think you're seeing in terms of some of the use cases that are really getting traction from the privates that do compete with the public companies. One company of note is Anysphere with its product Cursor is a coding assistant. It automatically generates code, does this vibe coding. And this sort of coding, automatic generation of code is something that Microsoft does, for example, and Microsoft wants to capture that market. But Cursor's making significant inroads in a lot of large enterprises. So that's a great example. A smaller example of something that I think we'll see more in the future is a company called Sierra. And Sierra is one of a class of AI natives that focus on agentic AI. And this is the use of agents that can function almost as human beings do. And they can either function with human assistance or they can function autonomously. And Sierra is ultimately, their strategy is to build a customer service agent that can handle customer service inquiries and take actions in enterprise systems. And that is something that, and that's the first part of their strategy. I think over time they'll broaden that out to cover other use cases, but that will directly challenge Salesforce.com and their Agentforce product. And that's something else you're seeing from these large public SaaS companies. They are almost all of them are adopting an agentic AI strategy to create agents that their customers can use to do things autonomously in their systems. And I think although Sierra looks promising, Sierra and other companies like it will be challenged to make inroads. The SaaS companies have an upper hand in the fact that they manage the customer data. They can control that data. They can make it hard for these AI natives to access that data, as we're seeing some of that happen recently. And they can integrate these agents with their application workflows. So it's going to be a while in coming, before we see that significant inroads being made by the AI privates, but you're still seeing some of these AI natives with their models, and then broadening those strategies from the large AI natives to be entire platforms. I think we're going to see more of that, and ultimately those platforms will be a significant force in software, we believe.
So in the meantime, Steve, as an investor, what do most investors don't have access to those private companies. So among the publics, should people be buying something like Salesforce as it gets into agentic? How are you gaming out the odds of which software companies are going to be successful with agentic or whatever other AI features that they're putting forward?
Yeah, it's a great question. And all of the companies we cover have some AI angle. It's going to take a while before monetization from the AI strategies by the public companies can really move the needle on their revenues. But I think, investors are looking hard to try to figure out who are going to be the AI winners and who are going to be the AI losers among the public companies, who benefits and on net, and who's going to have more of a challenge on net. And I think that can influence stock prices as well. And right now, I think there is some degree of skepticism about how quickly Salesforce's AI strategy can benefit them. But on the other hand, a company such as Autodesk, which is not really, it hasn't really gone public in a big way with its AI announcements. They can do some very interesting things with AI. And what Autodesk focuses on from a core product perspective is essential design tools for architects, for engineers, for product designers. And these design tools are standards in their industry: architecture, engineering, construction, and manufacturing. And Autodesk has an opportunity to use AI to help engineers, help product designers and architects start with an idea, and from this idea, create whole designs and have the AI help with that design process to not only create the ideas, but put them into a 3D model, for example. And I think we're going to be hearing a lot more from Autodesk around September 16th, 17th. They have their annual conference, the Autodesk University. And I think we're going to be hearing a lot more about their AI strategy. That'll be pretty exciting.
Interesting. So it sounds like you agree with the CEO then that AI is not going to eat Autodesk. But before September 16th in that conference, of course, we're going to get Salesforce numbers after the close tomorrow. As you mentioned, there's a lot of skepticism. The stock is down 25% this year already. Do you think that tomorrow we're going to hear something that salvages that? Do you think people should be buying Salesforce going into those numbers?
Yeah, I think tomorrow with Salesforce, it's going to be all about the numbers. I think there's nothing that Mark Benioff can say about their AI strategy that's going to change investors' opinions, but it's really going to be about the numbers. And we're not trying to call this print for Salesforce into the quarter. If they can make the upper end of their guidance, that implies that there's going to be a positive inflection in their sequential revenue additions for their subscription revenue, and those sequential additions have actually been falling year on year for almost like 12 quarters for Salesforce. So that could be a positive sign if they can just make those numbers. It could help shore up some investor confidence. But ultimately, I think what investors, many of them are hoping that Salesforce can grow double digits again, and now they're in the high single digits, and there's a hope that AI can propel that. We think that's going to be a tough challenge to move the needle on, at least on organic growth at Salesforce, to get that back into double digits. We don't think in the near future AI is going to be doing that. Maybe a few years out, but not in the near future.
Coming up, more on the companies and technologies shaping tomorrow's world. Stay with us.
vehicle purchases. It's set to expire at the end of the month. That has EV makers scrambling to offer deals to attract consumers while they still have that incentive. Joining me now is Carl Brower, iSeeCars.com executive analyst. Carl, it seems like these deals are out there while the incentives are in place. How is this playing out on lots around the country?
Well, we're definitely seeing that pull forward effect, which is the term in the industry we use when everyone knows something's going to change and people who might have been on the fence or thinking of a purchase in the next 6 months decide to make one in the next few weeks because of that change. So I think you're going to see third quarter EV sales probably go up slightly or at least remain strong simply because people who want to buy one are going to jump in before that September 30th deadline. But I think then after that, we're going to see a pretty big drop off. I could see us, especially because of that pull forward effect, it has the opposite effect when those things do change. And I could see us dropping well below 4% immediately after the September 30th incentive goes away and maybe settling in the beginning of 26 around 4%.
If the inventory doesn't move to the extent that the automakers want it to move, though, are we going to continue to see promotions and price cuts even after the incentives expire?
We probably will. There will probably be additional efforts to move the vehicles, even with the incentives gone. You may remember a couple of years ago when General Motors ran out of the $7,500 credit because they'd reached the cap on how many they could sell for that. They simply lowered the price of cars like the Bolt, the all-electric Bolt, by $7,500. So we'll see if there are similar price reductions after the incentive goes away.
And what does this suggest, Carl, about underlying demand for EVs, right? If you look at what consumers are prioritizing when they're going car shopping, is price always number one? Or, how do people think about those decisions?
For people who are more affluent, price can be a secondary concern. And not surprisingly, those are a lot of the people who buy EVs. But certainly, mainstream buyers, price is number one. And I think, even before, again, the incentives go away, we saw the new car market share peak around 8% for electric vehicles. And people were thinking it was going to just keep accelerating. We'd be hitting, 20% by next year and easily 40 or 50% by 2030. And, at IC Cars, we were studying individual markets for years, and we watched how markets that were kind of ahead of the game on EV transitions, when they got to about 7 or 8%, the growth rate slowed dramatically. So I believe under the current circumstances with the credits and all, there's like an organic kind of tipping point at about 8% where demand starts to really slow down because mainstream consumers still see a lot of limitations with EVs. And without the incentives, plus don't forget the manufacturers aren't going to have incentive to build the cars. There's every indication that regulations and penalties if you don't sell enough electric vehicles are also going away. So there's neither a carrot nor a stick to sell these vehicles. And I just think, consumers are still very worried about things like infrastructure, temperature. If you live in a colder climate, you lose 30, 40% of your range. It takes much longer to charge. There's still a lot of restrictions with electric vehicles, and a lot of consumers recognize that, and they're just not willing to take the chance or try one out yet.
So, Carl, if we zoom out and look at the car market overall, we're going to be getting some of the monthly sales figures in the next few days from the major automakers. It's not as though you're looking at a robust overall car buying market, even XEVs, right?
That's exactly right. Yeah. I mean, I think, it's interesting. I was watching your former guest and, I feel like there's kind of been a teetering right now. We're not definitely sliding into recession, but it does not feel like there's this robust confidence in economic circumstances. And I think that's limiting consumer willingness to commit to large purchases. And car companies have been slowly kind of moderating their prices. We're finally getting back to like MSRP or even, below MSRP, which is where most cars sold for most of the history of the automobile. But since the COVID constriction, they've been priced way high. So it feels like we're at a tipping point for regular cars, as you're saying. And the fact that we've got EVs, which have even bigger challenges to sell, and we're losing those incentives and losing those regulatory requirements, they're going to drop. They're going to drop to around 4% or less after everything settles out.
So, Carl, are there any automakers where they are really sort of retaining that demand? Are we seeing, you mentioned, of course, on the higher end, maybe people are faring a little bit better. maybe on the lower end, you're seeing the cheapest cars still move. Is it the middle that's the most challenged in terms of price point, or are there certain makes that people feel are still a good value?
It seems like all of them are really struggling. I don't think there's anyone that's going to be protected from this. Tesla's still, of course, the biggest seller in this country, but for various reasons that a lot of us know about, he's facing reduced volume and reduced revenue. I think he realizes he's got to get self-driving going, because that business model of selling electric vehicles that keeps growing isn't going to do that anymore. But, you look at pure EV makers like Lucid or Rivian, who that's all they're selling beyond Tesla, of course. And, I feel like Rivian may get just closer to Volkswagen because they're already working together, and they may need to. Lucid's got a big investment company in the Middle East that's funding them, so they may be willing to keep dumping money in. But the idea that any of these pure EV makers are going to grow versus contract over the next 1, 2, 3 years, I think that's impossible. I don't see how any of them grow in the next couple of years.
And then, Carl, there has been a trend of hybrids picking up some of the slack, right? And automakers making more of them. They're proving a bit more popular again. Do you see that trend continuing?
Absolutely. We've got the all-new Toyota RAV4 coming soon, 2026, and it's going to be nothing but a hybrid. And it's the best-selling vehicle in this country. Same thing with the last redesign of the Toyota Camry. So mainstream cars absorbing or adopting hybrid technology, I kind of equate it to fuel injection. Once upon a time, that was an advanced technology for high-end race cars and performance cars. Now you wouldn't build a new car without fuel injection. I think that's going to happen to hybrid technology. It'll just become very dominant, because why would you waste all that energy when you're slowing down and stopping, just making heat? Why not recapture that and help you get going again, which is essentially what hybrid technology does.
Welcome back to Tech Domain. Up next, we dive back into the shifts transforming the tech landscape, from market movers to emerging trends.
The shares of Broadcom lower with the rest of tech this morning ahead of the chipmaker's upcoming third quarter earnings. They're scheduled for Thursday after the bell. This comes as the NASDAQ 100 rallied for its fifth straight month in August, its longest winning streak since March of 2024. Paul Meeks, Freedom Capital Markets Managing Director, joining me now. And Paul, before we get to Broadcom specifically, let's talk about tech more broadly here, because we do have this sell-off today after that winning streak that we've been seeing for tech. We've seen some rockiness sort of creep into the equation here over the past month or so. Sort of big picture, how are you thinking about the group?
Well, the downdraft in the tech stocks actually started last week, and it continues. And of course, we know, as you just mentioned in the lead-in, that September is typically a pretty grisly month for stocks, and particularly in this really confusing geopolitical backdrop, I would expect more of the same. So bottom line, Julie, is if you are a tech investor or an aspiring tech investor, there is no rush to buy any of these names, even your favorites, probably over the next weeks, maybe even over the next couple of months.
And what do you think are going to be the big sort of negative pressures on them? Or is it mostly sentiment-based here?
It's definitely sentiment-based, but there's going to continue to be until we finally have a deal done. As we know, the deadline has been pushed back and pushed back and pushed back. But I'm talking about the big comprehensive deal between China and the U.S. pertaining to tariffs, and probably even more importantly for tech, to export controls, particularly for the AI GPUs from the likes of AMD and NVIDIA. Those companies are representing the key theme driving the tech sector. And of course, the tech sector with its overweighted names drive the overall market. And so it is super important. And we'll have to see what happens in the end. But every time we seem to get closer to the finish line, it just keeps getting pushed away.
And we just had a DC policy analyst on who talked about the meetings this weekend in China between President Xi and Putin and Modi, maybe making things even less likely that there would be some sort of agreement. This morning, we've got the U.S. pulling TSMC, Taiwan Semiconductor's ability to ship components that it needs into China to make its chips. So all of that going on. Last week, Paul, I talked to Jensen Huang of NVIDIA after the earnings, and we talked about why the China market is still so important for the company. This is what he said.
It would be great for China, and we have an opportunity to go capture some of that $50 billion that is growing at about 50% every year. The second largest AI and computing market in the world. America should be part of that. It's great for exports. It's great for our treasury. It's great for American technology leadership. And it enables us to leverage that leadership all around the world.
So in other words, Paul, here's a company that obviously is growing handily without China, but Jensen says we still need to be there. And so to your point about the China deal sort of hanging over everybody's heads, is that what's needed in order for tech stocks to sort of get their groove back?
Well, I think a comprehensive deal is very much needed, and I expect what happens here, Julie, is not only settling or coming to some kind of at least stalemate on tariffs, that we will address the AI GPU export controls. We'll probably also figure out where does the U.S. operations of TikTok end up residing. And so a lot is on this, and it's a very important catalyst. And even if NVIDIA in the short term has so much demand from other regions that it can get by without these China revenues, over the long term, they and the rest of these companies in the supply chain must be in the China market. They absolutely must. This is a situation, believe it or not, at least in my opinion, I believe that we need them much more than they need us.
Paul, I do want to turn to Broadcom and getting those numbers after the close on Thursday. This has been, for many investors, the sort of NVIDIA alternative, or at least addition, right? And so what do you think we're going to hear from them? And is that going to be a potential reason for people to get in here?
Another great question. So first of all, even though I'm confident with what Broadcom will say and do on Thursday night, the really nasty, particularly the guidance from Marvell last week, makes me incrementally concerned about Broadcom, even though Broadcom versus Marvell, Broadcom's a much better managed company. Broadcom not only has these custom chips that they're designing for the hyperscalers, but they also sell a big market of components into data networking. And then, of course, also Broadcom is a hybrid. It's part semiconductor company, it's part software company. But we will get a tell. Hock Tan, their CEO, just like Jensen Huang over at NVIDIA, is very carefully followed with his comments, not only as a barometer for his company's success, but the broader industry. And so it'll be a pretty important tell, particularly after Marvell scared some folks last week.
Thanks for tuning in to Tech Domain. For more tech coverage, expert interviews, and market insight, head to yahoofinance.com. Until next time.
Howdy, y'all. I'm Elizabeth Gore. Welcome to The Big Idea from Yahoo Finance, the show that navigates the world of small business and entrepreneurship. All businesses start with one light bulb moment. And each week, I'm going to take you on a journey with America's entrepreneurs. As the co-founder of the small business funding platform, Hello Alice, it has always been my mission to ensure that entrepreneurs have the tools they need to live the American dream. So let's cowboy up.